Hello and welcome to the 2023 market review. This year has been insane to say the least. We've had a lot of we've had everything. We've had inflation. We've had geopolitical issues. We've had energy crisis. We've had a lot of different things on the go, and that's led to a very rocky 2022. I want to get into that. But this one I'm going to do a little bit differently because so much happened. I'm going to split this up into two videos. This first one here is just going to be a summary. Try to keep it as short as possible. And then the second video, you just have to go to the YouTube page to find that. That'll be a much more long-winded review of what happened, and also a little bit more in depth as to my thoughts and feelings about the year. So, first things first, we'll start with just what the stock market did. So, every major market was down. Canada did the best out of the bunch. Also, a theme that we saw was a lot of people have been debating whether the value versus growth type of stocks, and how growth has had such a good run over the past decade or so, and if that means the end to value investing. Value investing is things like Warren Buffett, and that was kind of proved wrong this year. As it should do, companies with good, strong balance sheets that are worth what people are paying for them do better in down markets, and we saw that. Canada is a lot of its financials, and they held up very well over the past little while. Something interesting is it's very important to notice a difference. A lot of people, when they're talking about the stock market, they're referring to the stocks and bond market. They say, "Oh, how are the markets?" It's very important to notice the difference between the two. The bond market does not act the same as the stock market, and the stock market does not act the same as the bond market. In typical years, what we see if we're going into a recession or some type of retractionary event in the economy is that stocks will come down and people will flee to safer investments like bonds. And bonds, the reason they're safe is because they're tied to interest rates. Interest rates don't move that much, or so we thought. We've had the fastest increase in interest rates ever in history, and that has caused this huge down in the bond market. But it's very different, and I want to tell you why I'm not really scared about it. And it's actually not all a bad thing for investors, and that's because the yield on bonds has gone up. It's risen. And typically when we see downs, it's normally due to a fear of either banks defaulting on debt, or governments defaulting, or companies no longer being here. It's similar to like 2000 and 2008, when people thought we were heading towards an economic collapse, or even in COVID, when we thought the world was going to be shut down, and we had no idea what was going to happen, and that caused major events in the market. Because of what's happened in the bond market, that's very different. As we've looked at before, when interest rates go up, bond prices come down, and it's more of a mathematical thing. And that is why I am not super concerned. If we look here this is the fixed income market broken down a little bit more. But we look here, so this is government debt. So governments, AAA quality, highest quality out there, that has the ability to just print money. The bonds were down almost 30%. That's a lot. That is huge. And in the stock market, if that happened in the stock market, you're looking at it thinking, oh man, something bad must be happening to companies. But bonds do not work that way. Bonds are so tied to interest rates. So a good example is if you had to give somebody $100 and you could choose between receiving $1 a year from that $100 or $5 a year from that $100, who are you going to pick? Well, of course, you're going to pick the $5. And it's exactly the same in the bond market. Why would I buy a bond off somebody when they're only paying 1% when I can buy 5%? And the only reason that we see this type of return, this type of minus 30 return, is not because we fear that in 10 years the governments will not be able to pay back the $100 that you gave them. It's because the new debt that they're giving is paying $5. So if you're going to sell it today, as we looked at earlier, why am I going to pick the $1 over the $5? And so to make those bonds more appealing, to be able to sell them in the marketplace, you have to reduce the amount that you're selling for. So instead of selling them for $100, you're now selling them for, in this case, $70, because bonds, that's how they're valued. If you keep it to the 10 years, you still get your $100 back. It just means throughout them 10 years, you was only being paid $1 on that $100 instead of the $5 you could have potentially got. And that is the story of the bond market. And that is why it's not as scary as when it's a stock market decline, because it isn't based in this fear. It's based on maths. But what does that mean? That means going forwards, bond market yields and returns are finally attractive again. And if interest rates come down, we should see a good chunk of these of this return come back. So that's where we sit. It's a case of unfortunately, more than ever before, low risk investors, because they're predominantly in the bond space, were hurt more this year than higher risk investors that were predominantly in equity. But it's important to note that doesn't mean you change your investment philosophy because of the 1 year where interest rates went up really quick. We're expecting interest rates to normalize, and once they do, some of this return should be clawed back, and the rest of it will be over. Will be a benefit. Will be over the next little while, as instead of the 1% we were being paid on bonds, we're now being paid 3 or 4% once interest rates normalize. So a lot happened in the markets, but that's the overall. If you do want to know my thoughts on everything else, I missed out a ton of information here. Please go check out my other video. And as always, this is annual review season, so if you haven't already, please book your annual review. If you need anything, I'm always here. I'll see you in the next one. Thank you. Goodbye.